Welcome to today's webinar, and thank you for joining us. My name is Forrest Bell, Senior Investment Advisor and Head of Financial Planning at Bell Investment Advisors. I have here in the room my colleague, Laurent Harrison, also an investment advisor and fellow member of the financial planning team. Today's webinar topic is financial planning for boomers. Before we start, Laurent, can you cover a few housekeeping items?
Thanks, Forrest. If you're having technical difficulties, please call our office at 1-800-700-0089, or you may submit a request for assistance via the questions box on your GoToMeeting control panel. If you have questions during the presentation, please submit them via the questions box. If we're not able to answer all questions today, we will provide an answer to you via email after the presentation is over. Before we get too much into detail on the presentation today, we thought it might be helpful to first ask, who are baby boomers? Why has there been so much discussion, articles written, and media attention paid to this particular generation? If you're born between 1946 and 1964, you are considered part of the baby boomer generation. If you were born after 1964 and all the way into the early 80s, you are Generation X. Most of the planning work we have been doing for clients over the past several years has really been part of this boomer generation. So back to baby boomers. The boomer generation became one of the most active, the most physically fit, and one of the wealthiest generations up to that time. And in some circles, they are still considered the most wealthy generation in the U.S. today. Lastly, boomers benefited from education and government support for housing and education in the 40s, 50s, and 60s. Many bought houses with government subsidized loans, attended public schools and universities, and many became the entrepreneurs and business owners of today. One last slide before we really get into it. I thought this would be very interesting for you, these statistics. 76 million American children were born during this period. 60% lost value in investments due to economic crises over the last several decades. 42% are delaying retirement. 25% claim they'll never retire and are currently still working. The last two bullets on the slide have been creating either concern and passionate discussion in government budget discussions, or perhaps some happiness and smiles, depending on which one gets discussed. Bell's planning team has been doing the majority of our planning work, as I mentioned, for clients who are part of the boomer generation. Doing so allows us to see trends in financial planning for that demographic. One trend we see relates to the desire for boomers to do more than just retire. So in working with our clients, what we found is that soon after achieving working financial plans, they turn to us and ask how they might do more. Forrest, can you talk a little bit about that?
Sure. Thank you, Laurent. What boomers needed to do in order to accommodate these extra goals is create some more financial flexibility in their plans. As Laurent mentioned, very soon after securing a sustainable retirement scenario through planning, our boomer clients turned their attention towards other things. And those other things sometimes were about enhancing the retirement experience, perhaps by retiring early, or purchasing a vacation home, but oftentimes their attention turned to others. They were very ambitious about giving in the form of charitable giving, and in particular to their families. Sometimes it meant additional support to their parents. Sometimes it meant additional support to their children, oftentimes in the form of helping with a down payment on a home. Real estate in California is expensive and prohibitive to young couples, and this is a way that a lot of boomers wanted to help their children. Another thing that we saw, another theme that emerged, was providing assistance with education, the cost of education, helping their children fund a college education, or even their grandchildren fund a college education. These are beautiful goals. It really demonstrates a lot of the generosity, I think, in the mindset of boomers, but achieving these additional goals is not such an easy thing. Take an example. Here we have a plan for a couple age 67, retiring now, They plan for living expenses of $100,000 per year in retirement. They have no other financial goals. We assume a long life expectancy here. We end the plan at age 99. An annual investment return of 8%, current assets at $2.8 million, and we're assuming an inflation rate of 3.1%. What you're looking at here is an example of our results reports. This is a spaghetti graph, and it's the best way to test a plan for variance over time. What you see on the left side of this graph with that vertical bar is the starting point of retirement. And if you move all the way across the graph to the far right, the other vertical bar next to the safety margin, that's the end of the plan. All the squiggly gray lines in between represent different scenarios imagined by Monte Carlo analysis to show the likelihood of actually funding this retirement, which costs $100,000 per year, inflating at 3.1%. If you look at the probability meter on the right side, you'll notice that this plan has pretty good odds of success, 77%, which lands it in the confident zone and allows this to be a plan that we would endorse. But let's add one of the goals aforementioned and discussed before that lots of boomers are contemplating and want to do for their children, namely funding a college education. You'll notice the assumptions are the same for the first planning goal, but look at the second planning goal. Here we're looking at the cost of 4 years at Stanford University. We're going to assume an inflation rate of 6.5% over that time frame. And just as a point of reference, last year, all expenses in a year at Stanford University cost about $52,000. You'll notice in this results report, also a spaghetti graph, the probability of success diminishes. That when funding this goal in concert with retirement, the odds of funding both of them over time, all the way to age 99, the end of the plan, moved from 77% to 60%. And so when clients see this, which is not a plan that we would endorse, and after compromising and sacrificing and looking at all the areas where they can be flexible, they came to us last year and they asked the question, how can I create more financial flexibility within my plan? And here are the ways that we found to be successful last year and all the plans that we did for our boomer clients. The first way that we found to create more financial flexibility in a plan was to maximize your cash reserves. There's still an awful lot of unproductive cash on the sidelines, and we absolutely respect the need for an emergency reserve, but there is a point at which you want to find a conservative and yet productive use for your excess reserves. Get an insurance review. Your insurance needs change over time, so looking at how your premium dollars do or do not align with your current risk needs is an important task. Maximizing your 401k. Oftentimes we find that there are parts of 401k plans that are inefficient, and designing a plan to handle that is a way to create more flexibility in your financial plan. Consider adjusting your living expenses. By virtue of living here in the Bay Area or California, a lot of equity will build up in your home. And there's a few ways to make use of it when you enter the withdrawal phase or retirement. One way is to downsize, and the other is to refinance. We'll be talking about both of those today. And finally, working during retirement. The work environment and work itself comes with a lot of beneficial things. You get to apply a skill set that you've taken a lifetime to accumulate in a community that knows you with a certain identity, and there's a lot to be said for that. So extending your career with part-time work in retirement is another way to create some financial flexibility. Laurent, would you please add some detail to maximizing your cash reserves?
Thanks, Forrest. In building plans for our clients, we often work with clients in either building cash reserves from the onset, or if those reserves are available, maximizing those cash reserves. As a first step in the process, we generally allocate cash into two buckets, and you'll see those in the slide in front of you. The first cash bucket on the left is designed for emergencies such as a job loss, or for unexpected events such as a new roof, auto accident, really anything that must be dealt with immediately to protect your family or work situation. These reserves we recommend to not be invested in stocks or bonds, but should remain in a savings account, preferably high yield, fully liquid, and accessible immediately. We generally advise our clients to target an amount of between 6 and 12 months of living expenses. We understand that this is a work in progress sometimes, but it's a great target to shoot for. The second step in this process is to allocate cash to this second bucket there on the right, called excess reserves. Given the safety of the first bucket, one can generally take a bit more risk with this second bucket, and generally we advise investing in fixed income securities, bonds of short to intermediate term duration and maturity. The goal of these reserves is to beat inflation without exposing yourself to the risks of the stock market. We advise our clients to target an amount, in this case, between 1 to 2 years of living expenses. So what you end up with is what I like to call the power of 3. You have this power of building an effective cash reserve strategy, which provides you the ability to maximize your portfolio. You have 3 different strategies, 3 different sources of money, 3 different risk levels, and really, depending on what's going on in the market, you have an ability to access your cash in really any market situation, whether it's up or down. What does this do for you? It gives you peace of mind. As I mentioned, markets go up and down. You probably are familiar with that much more than I am in some cases. And having a cash reserve strategy built into your overall portfolio strategy really allows you to effectively weather the up and down markets, and may in some cases prevent you from changing your investment strategy in times of volatility. This really positions you for unexpected events in your life. So just a quick tip before I leave this slide, take a look at your 401ks, your investment accounts, and bank accounts to assess where you are today, or even better yet, ask your advisor, your Bell investment advisor, for some help in this area. Lastly, before I pass it back to Forrest, this slide here is a performance slide. It's an example of what an excess cash reserve strategy might do for you. This is Bell's strategy. It's very effective at keeping pace with inflation and providing greater returns than just a simple high-yield savings account. This strategy in particular has returned 5.9% annualized over the past several years. However, the expected return strategy for this is 3 to 5% annualized. So Forrest, can you talk a little bit about the next area of flexibility?
Sure. Another way to add some flexibility to your financial plan is to perform an insurance review, and I think the benefits of an insurance review are best illustrated in 2 examples. 2 years ago, we helped a couple retire when we first ran through their plan and produced results report. The results were not where they or we wanted them to be, so we needed to strengthen the plan and find some financial flexibility for them in their plan. What we noticed is when we went through an insurance review that the husband had a term policy. He's 70 years old at the time and was a smoker that was costing $10,000 per year. And when we went back to the plan and we tested it for the spouses predeceasing each other, we actually noticed that because the wife had a really strong pension, there wasn't a need for the protection of his life insurance policy. He bought it for all the right reasons to protect his family, but at this stage in their plan, it wasn't needed anymore. And so by relieving themselves of the premium burden of $10,000 per year, their plan greatly improved and they had a lot more flexibility for other things that they wanted to spend their money on. Another example is from a couple that we helped last year who's not in retirement but preparing for it. In this case, the husband owned a whole life insurance policy that was decades old and actually a good policy. Because of the amount of time and premiums invested, the cash value was substantial enough that the dividends from it could cover the premiums and sustain the policy. This policy had an annual premium of $13,000 per year, and simply by letting the dividends sustain the policy, they freed up that money to look at a new, more relevant risk in their lives, which is long-term care. They were able to both pursue long-term care policies, so instead of paying for 2 policies, they could better earmark their funds for the risks they cared about most. Laurent, could you talk about adding financial flexibility by maximizing 401k assets?
Sure. Thanks, Forrest. Is your 401k plan right for you? It's a great question. The 401k plans were enacted into law back in 1978, and they've become a critical component of most retirement plans. So let's take a look at a couple of the key benefits. First of these is tax deferral. A 401k plan allows you to defer your salary to a retirement account without getting taxed on the amount you defer. But some other benefits include an employer match. It's a huge benefit if it's offered where a percentage of your contribution is matched by your employer. Could be 3%, could be 6%. This is essentially free money. You can also set up deductions via automatic payrolls. And if you are doing a rollover option in case you retire, you quit, or you reach age 50 or 55, there are rollover options available to you. Most 401k plans allow you to borrow up to 50% of your vested account balance or $50,000, whichever is less. However, while 401k plans are a great vehicle for retirement options, we really do like them, there are limitations that do exist. For example, in 2013, you're limited to $17,500 as a salary deferral. An additional $5,500 catch-up is allowed if you're over 50. The next three, however, are very important. We found that the majority of 401k plans have limited investment options. Typically, you might have 20 to 30 mutual funds with different risk and return components and objectives. Contrast this with an individual retirement account or an IRA, where one has literally thousands of investment options to choose from. Really a lot of different investment options, which allows you to customize your investment strategy. Many recent articles recently about the lack of attention that owners of their 401k plans are paying attention to in terms of their own decisions. What to invest in, what strategy, the risk levels to choose, how to change, for example, as you're growing older, are all questions for you, the owner. Lastly, inefficiency may be a factor as well. Investment options may have been excellent when you were, say, 20 or 30 years old and you had a lot of growth options in your particular 401k, but as you've gotten older and need more conservative options, those options may be limited in your 401k and not as efficient as it needs to be. So just a couple of tips, however, while you're doing your 401k investing, or if you have options for rollovers. Consider contributing to your 401k the minimum necessary to maximize your employer match. As I mentioned earlier, it's free money. However, consider at least a 10% salary contribution, even if your salary isn't matched. It's still one of the best investment options for your retirement. And again, remember, you don't pay taxes on this money until you withdraw it, generally after you retire in your 60s or 70s. As a best practice, here at Bell, we recommend that you review each of your investment and 401k accounts at least annually and rebalance as well. This term rebalancing, several of you may be familiar with it, but it's the action of bringing a portfolio that's really deviated away from its target, back into line, and that should be done at least once a year. Finally, evaluate the efficiency of your 401k plan. If it's not what you need it to be, and you are over the age of 50, consider this option called an in-service withdrawal. It's a great option, and the next slide that I have here focuses on what exactly it is and how you can make use of it. This option, the in-service withdrawal, allows you to move money out of your plan into an individual retirement account, an IRA, while still working. So in-service means you are still working for your employer sponsoring this plan. Fortunately, 70% of larger companies generally have this option. You'll have to check with your plan administrator to see if it's available for you. Often there's an age limitation or restriction. It's generally over age 50, and we've seen some plans out there that really require you to be 55 or older for this option. However, by moving these retirement funds outside of your 401k plan, you instantly have access to all those investment options I talked about in the previous slide. This allows for a much more active, more focused attention to your 401k funds, and given that it's probably your largest source of retirement, it's in your best interest to really do the best possible job with these retirement funds. Next, I'd like to turn it back over to Forrest to cover living situations.
Thanks, Laurent. Another way to add financial flexibility to your plan is to look at the equity in your home and consider either downsizing or refinancing. Again, to illustrate the power of downsizing, an example, planning example from last year relates to a client who has a beautiful home in San Francisco that was perfect really for her lifestyle at the time, raised a large family, but the amount of equity and net worth in that home is very, very high, very out of proportion with her liquid assets. So in her situation, where she is now, really struggling to get in and out of the home and not having the goods and services that she wants accessible, she's going to consider a downsize. And this is going to help in a number of ways. It'll put her in a situation where the goods and services she wants are more approximate to her. It'll help her facilitate a social life, which can get progressively hard to maintain in your 70s. And it will liberate a lot of capital, a lot of the equity in her current home, and allow her to fund a lifestyle more to her liking. But this option is not ideal for everyone. For some people, the best place to live for the next stage of life is their current home. And so if there is a thought or a consideration for how to make use of home equity, you can do it through a refinance. Here's another example. This is just looking at a home with a fair market value of $1 million. The mortgage balance is low at $100,000, so there's lots of equity in this home, or $900,000 to be exact. Were this person or couple to refinance 65% of their home equity out of the home with a cash out refinance, their equity would fall to $350,000, but they would have netted cash, specifically $550,000 of cash. The cost of holding that cash is 4%, or the rate of the mortgage. And so the question that begs is, what can you do with investments such that you could exceed the cost so that this would actually be beneficial in terms of generating more liquidity, but also being an opportunity or a way to increase the financial flexibility in a plan? So this environment is unusual in that oftentimes it's the case by doing a cash out mortgage at higher rates, that the only way that you can match or exceed the cost of a mortgage is to use the stock market, which is too risky for most people contemplating this possibility. In this environment, you'll recall from the excess cash reserve slide that Laurent showed you, a 5% return is very possible. And so you have a situation where without using the stock market, you can generate returns of 5%, which is north of the cost of the mortgage, which is, again, creating financial flexibility and liquidity within a plan. Before making a decision of this kind, there's some other important considerations, namely taxes, acquisition indebtedness, and home equity indebtedness. The last pair there relate to the deductibility of interest payments on a refinanced mortgage. And if anyone has any questions about that, please call our office. Laurent, would you finish by talking about the last way to create financial flexibility, which is to work in retirement?
Sure, thanks, Forrest. As I mentioned in the first part of our presentation today, many boomers expect to work into their 70s. Why? Well, it's often a choice of what we want in our retirement versus what we can afford. In working with our planning clients, many are choosing to work longer or to work part-time. This presents opportunities to change careers, do things differently. Part of this change, though, is due to the desire to stay busy and intellectually engaged. In fact, we have a career and life coaching group here at Bell Investment Advisors, and Bonnie Bell, who leads that, has done a lot of work with folks that are interested in doing some of these things. Whatever the reason, this will almost always have a positive financial effect on your retirement plan. So to summarize ways to create financial flexibility, we've got maximizing cash reserves, get an insurance review to take a look at those premiums, maximize your 401k. I mentioned a few tips on how to do that. Forrest covered adjusting your living arrangements in a variety of ways, and also either working full-time or part-time during retirement. So that's the end of our formal presentation. However, we've left a few minutes for questions, so if you wish to submit a question, again, please type it in the questions box on your GoToMeeting control panel. We'll answer as many questions as we can, but if we don't get to your question today specifically, we will get back to you, don't worry, with an answer after the presentation. So hold on here. Okay, it looks like we have one that's coming in here. Forrest, here's one for you. How do you expect a cash reserve strategy to perform in a rising interest rate environment?
That's a great question, actually, because as many know, bonds have been on a bull run that's lasted decades now because of falling interest rates, and that environment is not likely to persist indefinitely. It is our expectation that interest rates will rise, not presently, but in the future. And when they do, it is interesting to look at the performance of different kinds of bonds. We looked at this from the period of 1976 through 1981, which is a rising interest rate environment. And we're happy and glad to see that short-term bonds and intermediate-term bonds through that period of rising interest rates had annualized returns between 4 and 6%. Long-term bonds had a negative annualized return of about 1% during that period. But that confirms our position in cash reserves, which is we're focused on short and intermediate-term bonds, and will continue to do so because of how a rising interest rate environment adversely affects long-term bonds. Laurent, I see another question here. What are your thoughts on Social Security?
That's a great general question and a great topic. And in fact, that along with Medicare is our topics that we'll cover in more detail in the future at another webinar. However, I will say this. Most individuals or couples that we work with usually decide to take Social Security based on cash flow needs. If they need it early, they are likely to take it prior to full retirement age, as early as age 62. If they're working or have other sources of income, they're likely to take it at full retirement age or even as late as 70. However, we strongly recommend working with us, or really working on this yourself, to more carefully optimize the strategy by taking into account such things as spousal benefits and other age-based factors. In fact, there's been a myriad of articles that's written out there on how to optimize Social Security. And in fact, in response to that, Bell Investment Advisors has created a Social Security analysis offer as part of our planning services. And we're getting quite adept at helping our clients optimize that strategy and really maximize the income out of their Social Security benefits. So again, we'll cover more about that in a future presentation, as well as on Medicare as well. So I think we have time for maybe one more question. Here's another one that's coming in on 401ks. So Forrest, how do you time an in-service withdrawal from your 401k account?
How do you time an in-service withdrawal? So this is an important question, as Laurent mentioned. The first step is to check with your human resources representative to see if that provision is included in your 401k plan. Some people are not eligible for it, so that's where the investigation begins. And then after that, the time to do an in-service withdrawal is when you find that there's a part of your 401k plan that is not as efficient as the plan, your financial plan, would like it to be, in which case you can roll over the money, that being a non-taxable event, and invest it in a strategy that your plan is calling for efficiently. The only other thing to add to this is in-service withdrawals can be tricky in volatile markets. The process of in-service withdrawals can leave money out of the market for 1 to 4 weeks, and if the market has suddenly experienced a drop, then we don't like leaving money out of the market and risking missing any kind of recovery. So in those situations, the way that we time it is we use a dollar cost averaging strategy to mitigate the risk of a volatile market, which can make in-service withdrawals a more complicated affair.
Great. Well, I think that's about it. You don't need to wait for our monthly webinar, however, or letters to stay in touch. We update our website with new content regularly, and we post daily market updates on Twitter. Bonnie Bell has a blog focusing on career and life coaching issues. You can find that at careerlifecoaching.bellinvest.com. And as always, if you have a question about your portfolio, please don't hesitate to contact us by email or by phone. That concludes the presentation portion of today's webinar. A recorded version of the webinar will be available on our website within about a week. Additionally, all of our past webinars are available on our website. And next month, please join us on Wednesday, February 20th at 2 p.m., where we'll cover investment committee updates. That's for clients only. But thanks again for your participation today.